Great. Welcome everyone. We are going to talk about impact investing today, and we're going to have a kind of a casual discussion about what it is and where is maybe the country or the investors going with it. And we have Liz Simmie here today to help us navigate through all of those things. But I'd like to also have it be a discussion. So if you have a question, raise your hand and we can have a gentle discussion around it instead of just a presentation. So Liz, I'm going to hand it over to you and you can introduce who you are.
Thank you so much for having me. Talking about this topic is my absolute passion. It's much more interesting than the boring investment side of things, because it's complex and there's so many misconceptions about it, deeply held beliefs on the investment industry side and on the the philanthropy side. And I like to tell it as it is and help people kind of think through the reality, because it's much more complex than philanthropy is good, impact investing is good. Let's all cheer ourselves. I'm gonna do my background. I was raised in the church, the Canadian Episcopalian Church, with grandparents who, were service oriented, and parents who were service oriented across all parts, whether it was in their industry, Girl Guides, nonprofit, sports. And I thought that's what we as a community, our purpose in life was. Not, and it had nothing to do with the church. It just, you do a lot of volunteering at the church when you're involved in the church. And that's essentially how I was raised. It was impounded in me that our purpose in life is to help everybody, and it's not separate from church or school or businesses. There, the helping and the making life better for everybody exists across all of those things. As part of that, and as part of perhaps my age and the political affiliations of my parents, I didn't want anything to do with the investment industry. Even though my dad was in the investment industry, I wanted to make the world better. So I, spent my time studying economics and U.S. history to figure out how to go out and definitely not go into the investment industry, but figure out how my role was going to be in helping the people of Toronto, helping the people of the world as part of my career. And I studied a lot of post-Civil War U.S. history, a lot of Jim Crow, a lot of U.S. military and European and Canadian military history, which is a very not super traditional background for somebody in the investment industry or finance. And I studied a lot of economics. And I didn't study, traditional economics. I studied economics where you looked at the impact of tax on marginalized populations and how, if what some folks would describe as kind of left-wing hippie economics. But I did not know that at the time. I just thought that was economics. And I started my career in consumer market research. So I used to do P&G, Nestle's, big banks, consumer positioning research, product concept research, advertising research. And then my dad started an investment management firm, and he in about 2006, at about age 62, and I ended up as the third person there, kind of because I was looking for a change. I joined him in about 2011, and I figured if he was doing this, it must not be that bad for the planet and the people. So I stumbled my way into an investment management firm. And obviously that's because, my dad was involved, but I was raised, as I say, in the investment industry in this small, unique US equity shop. And not many folks get to work directly for their parent in investment research, and building the business, and getting to talk to clients and all this kind of stuff. And I had no idea what I was going to do with my life. I was going to go get an MBA or go be a consultant or something. I spent the whole time kind of trying to escape, even though I loved the job and it was great working with my dad. Being one of the only women at an investment firm isn't fun for anybody.
No.
You know, especially when you're the only one having kids and you're the only one who has to deal with a nanny and you're the only one who is looked at like they're too young and not like manly enough. And you know, and this wasn't, it's not it, some of it is very overt sexism and racism and stuff, but for the most part it's there's this belief system of what a wholesaler or an institutional salesperson looks like, and they look like a 60-year-old guy in a suit. And so
Right.
if you don't look that way, right, you people, you know, pigeonhole you into roles and all this kind of stuff. Anyways, fast forward to about 2018, 20 early 2018, late 2017. I started getting interested in ESG, and ESG is environmental, social, and governance data. So the data that a company produces that's wouldn't fit nicely in their traditional financials. So workforce diversity, water use, emissions, turnover, all these kind of, you know, soft workforce things that traditional investing thinks aren't that important, but corporations think are important. And anybody who's ever worked for any company of any size knows that treating your employees well is a financial thing. The investment industry doesn't quite get that. But my co-founder had been in sustainable investing, impact investing, ESG land, as I like to call it, for about a decade. And her and I realized that all these big investment firms were trying to launch these products, whether they were impact or sustainability focused for clients who were interested, but they weren't correct. They were not meeting the end client in their needs. And
I want to ask one question, because when you talk about, you're saying the ESG, you say ESG, you say impact, you say it, I think people don't understand what each one really is, right? I think we put them all in the same bucket. So what is, when you just said ESG, it was the data, right? So that's not, ESG is not an investment product, it's the data that we gather. Is that accurate?
yeah, I'll give you an example.
Okay.
This is the most confusing part, especially for people in the investment industry.
Yeah.
So let's say we want to measure the impact a company makes on their local community. Okay, they could be a 2-person company, they could be a 2 million person company.
Yeah.
And we want to measure how many employees from that company have to go to food banks because they're not being paid enough. They're not being paid a living wage. So we need the data on the workforce, right? Who in the workforce is underpaid relative to the average livable wage? Where are they located? What's the monetary amount that they're being paid for a full-time job below what the livable wage is? And so those are impact metrics, and how we improve those, right? How we pay more decent wages, how we get employers in that community, how we have, you know, more woman-led single parent households or more folks from marginalized communities living at livable wages or above, and the positive impacts that that makes on those communities. All of those are impact measures.
Yeah.
And they're also all impact, whether positive or negative, but they're also all ESG metrics because
Yeah.
they're non-traditional financial metrics. And so that's where it gets confusing. People like to try and separate and say, oh, ESG, you know, I'll back up for a second. We're gonna skip to the history of impact, because you have to go back to the history to kind of get this. So we're gonna start with the nuns and the Quakers. Okay. The Quakers and the nuns, and frankly all religious groups in North America and beyond, they amass wealth. And I think it's, who is it, the Mormon Church has a secret $40 billion hedge fund somewhere. I'm not sure they're big impact investors, but Religious groups who do a lot of service work, for example, could not have their investments over here ignoring the service work that they do, right? And so you have a bunch of nuns who are working on poverty, working on, feeding the hungry, working on helping people get trained in jobs. Their investment portfolios that they have amassed that help fund their work, they realize that those investment portfolios, whatever's in them, doesn't matter if it's a private equity fund or stocks or an ETF or whatever, those could not be counteracting the work they're doing over here. And so when you go back decades, you have the early impact investors, let's say buying shares of a gun company to go to the annual meeting to talk to the gun company on how to improve the safety features on that.
Oh, I see. Yeah.
And there you have them, engaging with a big company who's not paying decent wages in an area. Or there's a whole bunch of reasons why a group, or working in micro lending in Haiti, or there's a whole bunch of reasons you can see why a group who's doing all this work in their local or other community would then say, hey, what can we do with our investments and our decisions about what investments we invest in, how we manage those investments, the teams managing those investments. You can see how that evolved from, not just excluding a bunch of bad companies, but to finding good companies and encouraging other companies, big and small, to improve with that investment dollar. And so, the South African apartheid is the best example. A big chunk of the early pushes against the South African apartheid were around racial equity in the US, and a lot of these groups believed deeply in the need for equality, pushing the companies that they owned to divest from their operations in South Africa. And that actually pushed the apartheid over the hill and helped push, helped get everybody together to end the apartheid in South Africa. So it goes everywhere from the tiniest decisions of investing to active geopolitical campaigns. And those are, you can see how that's all impact investing. We're trying to reduce negative impact and create positive impact with our investment tools. And that's why you can't separate ESG completely out of impact, even though the industry likes to, because what is that impact? Well, gender equity, racial equity,
right. Okay.
Reduction of emissions, less pollution in the local communities. Those are all ESG metrics. And really, ESG comes from a bunch of different places, but Larry Fink went on a big, campaign a few years ago, and it became a catch-all for public markets impact investing or impact intended investing. And it really, it's the term's flawed, because a lot of the ESG data that the teams use in all types of investments is actually fundamental financial company data. So a well-run company treats employee turnover as a financial metric, because it costs money to replace people, right? And you're better at retaining good talent if you don't turn it over. So we have, on one hand, we have corporations doing good or bad in the world, treating this ESG stuff as core to their operations. But the investment industry at large doesn't like non-financial metrics. And so ESG, the term and the grouping of that data got separated from financials. Even though I'd argue that in proper, in a well-run company, in any type of impact, those things have to be integrated together and not separated. So that's the very confusing kind of 3,000 level view of, people like to say impact is privately owned, direct investments that positively impact people. Well, big companies impact people too.
Right.
And So that's the kind of the bandwagon, not bandwagon, the argument that folks of all types will make is you can make an impact in small companies, you can make an impact in medium-sized companies investing, you can make an impact in big-sized companies, and there's a bunch of different ways to do it, whether you as a shareholder are advocating, whether you as a shareholder are just holding them instead of holding a company that's doing worse to the world. And the companies, the companies themselves of all sizes, they can drive impact even without shareholders getting in their way, right?
Right.
And so anyways, I'll stop on there for a second, because it is wildly complex, but at the same time, I find non-investment professionals just get it very
Yes.
easily. The
Yeah.
investment folks that don't.
And I think that that's a good clarification, right? And another question I would have, and maybe this is not the right place for it, but when as an investor, right, and I want to choose to be impactful, right? I want to know what is the purpose of the fund rather than it's just an ESG fund, right? Like, what is the impact that it's making? What are the data items that they are monitoring? And what is that investment company? What is their goal, right? And most of those funds will have that. Yes, no.
We're in a very interesting stage of the data.
Yeah.
Because there's two types, there's two things that and I'm talking about the underlying companies that are in a fund. And
Right.
this could be a private equity fund or a public markets, a mutual fund or ETF.
Yeah.
There's the output, the product or the service the company makes, right? So if we make a product that's windmills, that's renewable energy, if we make a product that's reasonable and healthy food, that for staple food, those are easy to see that the product and the outputs more positively impacting things.
Right.
Versus, tobacco, probably everybody can see that there's a negative output, negative impact on the output of tobacco. But that's only part of the story. The other part of the story is what's happening inside of the company. What's happening? How is payroll? How is pay equity? How is decent work? How is gender and racial equity? Women in leadership roles, are they getting a fair chance? Those are positive impacts. And we're at the stage now where we can begin to actually quantify those. And it doesn't matter if you're in a private fund or a fund like ours. We're getting to the point where we can say, hey, in the Honeytree ETF, our companies in aggregate increased women in leadership by 15% over the past 3 years. And right now, we don't actually have the index data for that, but I can tell you the index is probably flat on that because so many companies can't improve those metrics, right? And we could measure it as trees saved, which is a interesting metric, or renewable energy used instead of other things. There's all these interesting different ways, but again, it has nothing to do with whether the company's giant or little. A small company with 10 employees also, has to figure out how to, build a diverse team. And it may not be gender. They may be all women. How do they increase the diversity of their team beyond gender? Now there's a whole bunch of different metrics. So we're in the early stages of quantifying that. It's only really been since 2016, 2017 that big companies started reporting this workforce data.
Yeah.
But that data is going to be required reporting for big companies and small companies in the next 5 to 10 years, so that folks like me and large corporations and all types of folks who use this data can start looking at the workforce impacts, positive and negative, the environmental impacts, positive and negative, of companies in a more consistent way, the same way we do with financial statements. So the answer is impact is one of the reasons we were so focused on only measuring the impact of the output of the company is because we didn't have the data to measure the operations, as I like to call it. But when you have 500,000 employees, the decent work that you pay or the lack of decent, salary that you pay can have a huge impact. I think the stats are the same in most parts of the US. 1/3 or more of folks who use food banks in Toronto have a full-time job. And
Holy
so,
cow.
we can, how are we as a society going to worry about donating to the food bank if there's companies out there paying too little for folks to afford food for their kids? And so
Yeah.
that's where the fun stuff in my mind
Yeah.
gets interesting, because that's intuitive, I think, to folks out of the investment industry. But parts of the investment industry say, you know what, corporations' only job is to enrich their shareholders. They don't need to worry about any of this stuff. They do need to worry about this stuff. When it gets out that you underpay or you have worker safety issues, it is bad for your bottom line.
Yeah.
And Amazon's a great example. Amazon does lots of good things and has lots of jobs that are really high paying. But then we've all heard the stories of the warehouses and the labor exploitation and all that kind of stuff. And that makes you think a second as a consumer. And so that's it, it's the most fascinating, complex, yet straightforward topic ever. And never trust the investment industry. We all throw terms around as marketing tools all day, every day.
Yeah.
Um, but the impact, I guess the summary is, there's many ways to make impact in your business, in your community, and with your investments. And there's no one right way. And we're gonna see it get, we're gonna see. I'm not sure if I sent you my annual letter, but we're trying to measure the reduction in water use of our portfolio
Yeah.
companies, the increased gender and racial diversity in leadership roles. All these things that we're beginning to get multi-year data for. And I think that's the future of impact, because small venture capital companies are also going to have to report that too, right? It's
Yeah.
things that are
So,
traditionally.
so do you think we will get to a point, and this is totally a crystal ball, that if big companies don't report this data and don't improve this data, that we're not choosing them. We're not choosing them in the ETF. We're not choosing them in the mutual fund. We're not choosing them as investors, so that we make an impact as investment professionals and investors to say, we're not investing in you if you're not stepping up to the plate.
Yeah, I think it's already happening in bits and pieces.
Yeah.
Um, now a lot of it is lipstick on a pig kind of
No.
stuff.
Yeah.
Climate is a great example.
Yeah.
Science-based, like net zero targets. Everybody's heard of net zero targets.
Yeah.
Net zero targets are like 30% women in leadership targets. Some companies are going to achieve them. Most companies are not going to achieve them.
Yeah.
But unless we have data that we can measure with some level of belief that it's true, we can't hold anybody to account. And so just last week, the SEC released rules that require big companies and eventually little companies, but starting with the big companies, to report their emissions in their financial statements.
All right.
And next is coming this workforce diversity data that I've been talking about.
Yeah.
Because it's been Department of Labor has been requiring the reporting for 8 years now. And so the data exists. And the reason the data exists, the Department of Labor California started to realize that all the Hispanic immigrants weren't attaining income levels of the rest of the population in California. And so they started saying, okay, if you're a big employer in California, you've got to report gender and racial diversity by level. So here's your executives, here's your directors and above, here's your technical folks, and here's your workforce. And it's really a tool to help companies begin to just start to think about this stuff. Because smart companies know that if they can hire more women in senior leadership roles, their pool of candidates gets bigger.
Right.
It's not about displacing who's already in senior leadership. It's about increasing the quality of who you're hiring and increasing your ability to retain them. I already talked about, being a single, 10% of folks in my role, portfolio managers, are women, only 10%. We haven't made any progress in 2 decades. But a smart company, like an industrial company in the Midwest or Texas, who
Yeah.
understands that the more women, I like to point out that Texas does lots of super duper ESG, DEI stuff, and so does Florida. A smart company who can say, you know what, if we got 8% women in leadership right now, if we can get that to 16%, we'll retain more of those women in leadership, who are all great, by the way, and they're all excelling at their job, but will also be easier to recruit more women in our workforce and more women in leadership, which doubles our pool of candidates. So you can see how the impact that they're realizing is actually tied to their bottom line. So they're not,
Right.
they're not recruiting women because it feels good and it looks good on a survey. They're recruiting women because they're smart and they're running their business properly. Same thing as you would be running a community properly. If you run a community properly, you realize that starving people cost money. People with no access to healthcare cost money, right? And how do we, decrease those costs and improve the positive impact? So we're at a turning point in public company data on this, but the private companies, the private side of things, also, is they're going to have this reporting framework too. So it won't just be, hey, this company's making windmills, they're an impact investment. It'll also matter what their team is doing, what it looks like, what the tenure of employees are, what the pay equity is, the emissions they use for business travel. All these metrics are going to, in the next 5 to 10 years, move from cute little sustainability ESG impact reports, and I say all those words together because that's what they are, to financial statements.
Yeah. And so what's really exciting, I think, is that, I hear from some of my clients, they tell me, well, I don't have enough money to do impact investing. And so what this enables us to do, a fund like yours, is anybody can be part of the impact in investing. And it's so exciting to be able to say, okay, I can see what these companies are. My money's going to this, and this is why my money is going to this. So I think going forward, it's going to just enable more. And, most of my clients are women, so it's going to enable more women to get into the pool of impact investors.
Yeah, we've spent a number of years trying to the impact investing world, which we're part of, is a little what's the word? It's for rich people. And I say that in the nicest way possible, in an exclusivity sense. And whether it's minimums that are $250,000 requiring to be a permitted or accredited investor, deals being private, there's been this creation of only certain types of investments make an impact. But as I said, you can have a windmill company that's a big publicly owned company, and you can have a windmill company that's a tiny private investment. What's the difference other than the shares and how they're listed? Right. And part of that gatekeeping, because our whole industry is about gatekeeping, is we have this thing in North America and parts of Europe where we, as North Americans, as rich Western folks, think we know more about helping other people, making the world better than other populations.
Yeah.
And I call it savior complex. There's lots of, much less kind ways of describing it. But that's what kind of happens in the investment world, and the impact investment world is this, oh, we're better because XYZ, and, we're going to help all the poor people of the world be better. But, we've actually screwed up most of the world by thinking that way. And I think the investment industry is not very good at walking that back. But in investing, not everybody can access those private investments.
Right.
That being said, as I've said, there's not really any difference between a giant company that is really good at hiring women and making sure they have higher incomes, and a small company doing that. And so what we've done is we've built a model that finds what we consider responsibly growing companies.
Yeah.
And so these are in the US. They all are pretty big compared to, the local small businesses. But these companies, as they grow, are growing in a sustainable enough way that they can reduce their negative externalities and increase their positive externalities. And that's just fancy economic speak for doing less bad and doing more
Or
good
good. Yes.
on their stakeholders, because the companies that we're looking for are stakeholder governed. And I think
What is
stakeholder
that? So expand on that.
So in the investment industry, in traditional finance theory, the saying goes that the purpose of a company is to enrich its shareholders only. And that's just agreed upon. Companies are not, nobody's supposed to do other stuff. It's supposed to be the purpose of a corporation in traditional finance theory is to enrich its shareholders. Now, anybody who's worked at a company or owned a company knows that it actually the purpose of a corporation is much bigger than that, because you cannot enrich your shareholders if you screw your employees or your customers, or you get sued for dumping waste in the river, or blah, 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 blah. So stakeholder governance is actually true governance. And what stakeholder governance means is the board's job and management team's job is to serve all of its stakeholders, including shareholders, including the local community, including the employees, including the customers. And taking that framework of governance, you can see how a company can figure out how to recruit more women or pay a more decent wage, and how to them that goes back and says, you know what, we're going to make money and be able to continue growing sustainably because we're taking care of our stakeholders in this process. So it's very intuitive for non-investment people to say, of course, a company should care about its customers and employees, but it's not super intuitive to the investment industry's methodologies for those things. And I always like to say the traditional finance models don't have places for the environment or humanity to fit into those models. Right. And our model is a stakeholder governance model. We believe a company can make more money and grow more sustainably by paying their employees more. And the most recent Nobel Prize backs us up on that one. But a lot of traditional finance and economic theory says we're ridiculous and our companies are going to go out of business. But that's not true when you look at corporate beliefs. And so we're trying to find companies that understand the positive impacts that they make on all of their stakeholders is what drives their bottom line. So not despite all the good work they do, they still make money. They make money because of the good work that they do. And I'd argue every company, you could evaluate any company from one person to a million employees on this framework and these metrics. We just happen to be playing in the space of big companies so that our product can be accessible to the regular investor, for the people, as I like to call it, in North America. Because if we launched a venture capital fund going for the same concept, it would not be available to the people, right? Right.
Do you, when choosing the companies, do you ever go visit them?
So this is an interesting story. So my dad, who's actually joining us as the partner soon, built a $3 billion business, and he owned $3 billion in assets, a similar firm to Honeytree, with 22 companies in it. So he owned a large chunk of 22 companies, and he never met with management. Because when you go and meet with management, they're salespeople, and they make you fall in love with them, and they create emotional bias. And so when you need to fire the company, your heartstrings are pulled. And so we, even though we look at a lot of qualitative data and quantitative data, we don't meet with management. One, it would take me like 40, 50 days a year just to and flying everywhere and back to the environment. And I'd rather do anything else than that. But it is this, oh, I saw their offices. I know lots about them. Who cares what their offices look like? Frankly, there's this, idea among people like me, chief investment officers, go and meet with management secretly to learn more about a company, and then we get the edge, and it's a marketing activity for these corporations. And so we look at publicly available data, which includes publicly available ESG metrics that we
Yeah.
can use and where we're, I guess, different than a lot of impact and ESG shops in our spaces. We treat diversity data. So we look at women in leadership year over year, or racial diversity in leadership year over year, the same way we're looking at earnings growth year over year. It tells us a company is growing sustainably, has a functional management team, functional board, who's capable of setting goals and achieving them. And that sounds so simple, but lots of corporations can't do that. And it doesn't matter, who is it? The big Canadian bank, the banks all have really big teams who do ESG stuff and write their reports. The biggest Canadian bank in Canada just released an ESG report that shows a decline in their women in leadership over the past 3 years, right? And that's been their sales pitch for a decade. And so, we're looking for companies that can hold on and continue to increase, especially in areas like technology and industrial engineering related, and in finance, although we have no big banks because they're all pretty bad at making a positive impact on anything. If industrial companies in the Midwest and Texas and can I always like to talk about Illinois Toolworks, because nobody's ever heard of it, but it's this company outside of Chicago that makes parts of stuff. And they said one day, oh, you know what? We only got like 10% women in leadership, and we've only got 5% of our leaders are racially diverse. You know what we can do? We're gonna drastically increase that. And in about 5 years, they got to 25% women in leadership roles and about 15% racial diversity in leadership roles. So if companies like that in the burbs of Chicago can do that, why can't big tech in San Francisco or BlackRock or there's a culture difference and a belief difference and an ability to enact impact.
Yes.
And we want to hold the companies who are actually, who get it, who are trying and can move. They're not perfect. All our companies do stupid things, just like people do stupid stuff, even the best people. But when they do something stupid, they say, oh, you know what? I guess we got to fix that. And then they fix it, and then they keep on going. And I know folks in my job generally try and make things really complicated, but it's really simple. Good governance is really simple. We're either long-term focused in managing everything that impacts all your stakeholders, or you're a highly qualified team of experts who's not effective at firing your CEO when they do something stupid, or and we've all seen that. And it's you have to cut through the noise, the beliefs, the deeply held assumptions in the investment industry and in philanthropy and in impact to kind of get to the what and the why.
Yeah. Great. All right, one more question, and then I'm going to be conscious of everybody's time. How often are you looking at this data? Are you doing it yearly?
Yeah. So the majority of our data is annual, whether it's finance or ESG data. We're looking at what companies do on a daily and weekly basis, because if a company does something stupid, as I like to say, might be the reason why we kick them out of the portfolio. But we have to take a long-term perspective. So of course we're looking at quarterly financial updates. At the same time, we're looking at, we want to hold these companies for a really long time. We want them to be focused on a really long time period, and we want comparative data. So we run a process where we use a lot of quant data once a year. We rerun our universe, and then we track about 50 companies on an ongoing basis, of which 25 are in the ETF. And our companies are so boring. And I love it. They're not, you don't see them on CNBC. Nobody's talking about them. They're not cool among the hedge fund guys. And so we want them to be boring and not doing a bunch of stuff other than what they say that they're going to be doing. So that's the benefit of what we do in this type of model is boring. We absolutely monitor it regularly. At the same time, ESG data for the most part is only annual, and a lot of the financials we do are also only annual.
Fabulous. All right, one more comment before we go. For you, what one more thing should we know?
There's a lot of ways to be involved in impact that are not necessarily your investments, just like there's a lot of ways to be involved in impact in your investments.
Yeah.
One way that gets left off the radar is the ownership or supplier diversity. So by using a woman advisor or any type of diverse advisor, or using a firm, an accounting firm, a legal firm, ETF, or a mutual fund manager, where the ownership and the revenue flow is going to somebody not traditionally represented in the industry, which is everybody in investing.
Yes.
You're driving impact, right? The only way we're going to change the world across all metrics is, building up the capacity and the voices of people who are traditionally underrepresented. And in some industries, that might be men, kindergarten teachers and stuff like that. We do need more primary school teachers who are guys. But in the investment industry and a lot of professional services, it's pretty clear who by supporting them with your business, you can actually drive a lot of impact that doesn't fit nicely under the, windmill or, poverty type buckets that are more clear, but you're still driving impact.
Yeah, I love it. So great. I learned a ton, and I so appreciate your time. Yeah, thank you so much.
Thank you for having me.